Right, good morning everybody, and welcome to this special edition of HUBsights, Hub24's regular webinar series where we showcase some of our fund manager partners. We're lucky to be joined this morning by the team at AMP Capital. We have with us Dr. Shane Oliver, who's the Head of Investment Strategy and Chief Economist at AMP Capital. Shane's responsible for the provision of economic and macro investment analysis and is part of the broader investment strategy and dynamic markets team. Shane also leads the determination of AMP Capital's asset allocation policy, which is applied across more than 500 billion invested in multi-asset funds. Mr. Oliver has a PhD in economics, which focused on the validity of the efficient market hypothesis, it isn't, and asset price bubbles, there are. He is also an adjunct professor of economics at Macquarie University. We're also joined by Nader Naeimi, Head of Dynamic Markets at AMP Capital. Nader is responsible for leading the dynamic asset allocation strategy for the multi-asset group, as well as other macro strategies and asset allocation for several AMP Capital funds. Finally, we have Steve Mazzarelli. Steve is the National Strategic Accounts and Alliances Manager at AMP Capital. He's responsible for the development and execution of the AMP Capital sales and account management strategy across key strategic relationships within the Australian retail market. I'll now hand over to Steve.
Great, thank you Andrew, and appreciate the opportunity for AMP Capital to present to Hub24's key partners. Good morning everyone. What we're looking to do in today's session is to split it up into three parts. So firstly, we'll have Shane Oliver, AMP Capital's Chief Economist, will provide his thoughts on the global macro environment, and that will go for about 15 minutes. We then want to try and then link the global macro view to what that actually means for investing in the current environment. And Naeimi will take the discussion, if you like, to the next level and highlight some of the asset classes, the sectors, the regions that we like, and importantly, some of those that we have less conviction on. And then finally, we do want to leave about 15 minutes for Q&A. So please, I understand you can submit your questions online, so please do so, and we'll collate these and answer them during the 15 minutes of Q&A. So Shane, firstly, welcome. Clearly, a lot is going on in the global economy, as always. You've got this shift, I guess, from an easing policy stance or QE to a tightening phase in the US. There's the never-ending geopolitical risks, in particular North Korea at the moment. The data in Australia is looking pretty sluggish, but on the other hand, business conditions, GDP in the Eurozone are looking pretty positive. I guess over to you now to try and help make sense of all of that and I guess provide your thoughts on some of the key macro factors impacting global growth and more broadly in terms of share markets. So over to you.
Okay, thanks Steve, and thanks for everyone at Hub24 for this opportunity to speak to you today. What I thought I'd do is quickly run through some charts. As always, being an economist, I've got too many, so I'm going to zip through them reasonably quick, but there will be question time at the end, and of course, if you suffer insomnia, you can look at these slides tonight and they'll guarantee to put you to sleep. So off we go, zipping through macroeconomic updates. I think the one thing you note about the last few years, and this is the environment we're in, is there's lots of noise. We jump from one thing to another. Go back 4 years ago, we were talking about taper talk, the taper tantrums in the US, when the central bank there, the Federal Reserve, said that it might be appropriate soon to start exiting ultra-easy monetary policy. It took them more than a year to end quantitative easing, and of course, more than 4 years later, they've only increased their interest rates to just above 1%, and lots of other central banks will eventually follow them, but the Fed story is it's a very slow process. That taper talk set off a bit of a fallback in share markets. Then we've had Ukraine, Ebola, deflation. These things might seem like non-events now, but at the time they were big worries. Ebola was going to devastate the world. Brazil and Russia in recession, the big BRICS, two of them anyway, in big trouble. Worries about manufacturing, worries about Brexit, Trump, and of course North Korea. And one of my favourite sayings in investing is that if you, as an investor, want to make the most of the magic and power of compound interest, you've got to try and turn down the noise. And one of the best ways to do that, I think, is to turn that stuff off at times and watch reruns of the Brady Bunch. And you can see my hero there, heroine Marsha Brady. Bear in mind, I've been a Brady Bunch fan since the 1970s. At the time, we were both about 14. So this is not a Roll Paris story here. So in any case, moving on from the Brady Bunch to other things, Some of you may not know what the Brady Bunch was. If you don't, too bad. Check it out on YouTube tonight. Point about all that is despite all that noise, markets haven't been too bad. This is very important. Lots of noise, lots of gyrations, but lots of opportunities in there. Average return on a typical balanced growth superannuation fund over last year was 9.5%. That's last financial year. Last 5 years was 10%. And most asset classes there the last 5 years have had reasonable returns, except if you're in bank term deposits seeking to become a millionaire that way. Didn't exactly pan out and never will. Other asset classes have been a lot better. But of course within that there's been volatility and that's provided opportunities. But the trick here is to try and turn down that noise, keep that uncertainty under control. So how do I see things? Basically, I think the really important thing to note here is that over the last 18 months we've seen a good recovery in share markets. Why has that occurred? It's not much to do with Donald Trump. It's all to do with the fact that the world did not go into recession. All those fears from February of last year did not come to pass. At that point in time, Aussie share market down 20%. Global share markets outside of the US were down by more. The US was down 14%. The fears back then, a rerun of the GFC did not happen. Things turned out okay. Global growth has, in fact, picked up. And we've now got the environment globally where we've got the most synchronised pickup in global growth we've seen since you've got to go back to the immediate aftermath of the GFC, where everything collapsed and everything went up together. But in a fundamental sense, we're almost as strong in many indicators as we were in the years prior to the GFC. So pretty good recovery there. Lots of range in terms of the growth numbers. But the other aspect is we're still in a world of low inflation, low interest rates, and that's why it's still an okay environment in a fundamental sense for investors. Good growth, but low inflation, low interest rates, many central banks on hold, including our own Reserve Bank. Now, of course, at some point in time, the Federal Reserve will raise rates again, continue monetary tightening, probably later this month in the form of quantitative tightening away from the quantitative easing of the last few years, but that's going to remain a very gradual process. US dollar, very short term, we think could go lower, but ultimately, as the Fed continues to gradually tighten, other central banks are on hold, the US dollar will eventually see a rebound, and that will eventually push the Aussie dollar down. Low returns from bank deposits, government bonds, very hard to get excited about them. In the short term, big risks, I think, of a correction in shares. This is September. Look back through history, volatile time often. You've got North Korea, who knows what they're going to do. You've got Trump. Put those together, a lot of uncertainty around those two. You've got potential risk of a government shutdown in the US, debt ceiling crisis. I think the risks have receded a little bit there, but that's still there. And also what the Fed might do. So all of these things could give us a short-term correction. Always hard to know how far it will go. But I think the fundamental environment, 6 to 12 months, looks okay. So on to that, where we are in the cycle. I've sort of covered this one off. That's a stylised version of the cycle. The time to really worry about shares is when inflation is taking off, central banks are slamming the brakes on, but we're not at that point yet. And I think we have further to go. What's the proof point that global conditions look okay? Look at business surveys, what they call PMIs these days, surveys of purchasing managers in companies around the world, so it's purchasing managers indexes, and all of those readings, whether it's services, manufacturing, are pretty good, suggesting that global growth will probably pick up a notch. How does the US look? Saturday morning I got up with grand excitement looking at the latest jobs figures out of the US. Only an economist would do this sort of thing, or maybe Nader as well, I'm sure he does the same. But you get up and you want to see what the numbers are. I don't like looking at them before I go to sleep. It distracts my mind. At that point in time I'm watching Brady Bunch reruns at 10 p.m. on a Friday night. But in any case, what did those numbers look like? I think they were okay, a little bit weaker than expected. Hard to get excited though, because these numbers bounce around, but you're still seeing good jobs growth in the US. You're still seeing very low unemployment. Sooner or later, that's going to lead to higher wages growth, albeit from a low base. And you've got consumer confidence on the right-hand side of that chart, running around levels about as high as it ever gets. So the US looks good to me. What about Trump? Nutcase. No, I shouldn't say that. But anyway, I think he is a bit of a crazy guy. But in any case, I've got to be careful here. There's always some Trump supporters out there. The thing to note about Trump is you've got some funny people in the White House at the moment. I don't know how they managed to pose for that photo looking so dodgy. Even the Pope's upset with him, but Trump's got his traditional grin. Did remind me of the Adams family in the White House. that was the time when the First Lady didn't want to hold Trump's hand, and she's certainly not there. So moving on, thing to note about Trump, that you have to put aside whatever view you have of Trump from a moral view, whether you think he's appropriate to be president or not. You've got to put that aside, because the share market doesn't have a moral compass. It just focuses on the business aspects. And so far you've seen no trade war with China. He keeps threatening. The saying is, take Trump seriously, but not literally. Just because he says he's going to stop trade with China because they're not doing the right thing with North Korea, doesn't mean he's actually going to do that. He's trying to put pressure on them. So take him seriously, but not literally. But anyway, we haven't seen a trade war with China. He hasn't stacked the Fed. And so far, his focus is still on business-friendly policies, tax cuts, deregulation, infrastructure, and so on. And I think ultimately they'll get some progress there. At the end of the day, if you're a Congress person on the Republican side, your focus is the next election, which is November midterms next year. You want to keep your seat. And what do you do to keep that seat? Well, you get some of your program through. And the big one there is tax cuts. So I think ultimately they will get that through. Will there be a debt default? Will there be a government shutdown? Just think about this. Massive hurricanes gone through Houston, flooded big chunks of it. Not very good. They voted for Trump. He's not going to want to let them down. And if the US government shuts down and they have a debt ceiling crisis, he will let them down because the US government won't be able to function through that period. So I reckon he has to keep the government open, and there will be some sort of resolution to this. Could be a last-minute one, as there often is in the US, but I reckon they will solve it at the end of the day. So not too worried about Trump. Obviously, those issues with North Korea. What about this guy? One thing he's done is make wearing a suit look good, whereas Trump was making a suit look bad. That, I think, is Marine Le Pen, who's upended in the water there, a bit mean. But in any case, he's almost like the anti-Trump. If you don't like Trump, you've got Europe seems to be going in the right direction. Europe hasn't collapsed. European growth looks pretty good. That's very important. Business conditions running at very high levels. And ultimately, I think that will show up as continued strong growth in profits in Europe and ultimately support Eurozone shares. Will it break up? We've had election after election in Europe after Brexit, and they keep voting for the people who want to stay in Europe, whether it's Spain, Austria, Netherlands, France. Same story. Italy is the one to keep an eye on next year, though, because they have an election coming up by May next year at the latest, and they're not as supportive of the euro. So that's a bit of a risk. The five-star movement could get more votes than anybody else, but I don't think they'll be able to form government. So it could be uncertainty about Italy, but I don't think Europe's going to collapse on the back of that. Japan looks good. I'm zipping through slides here in the interest of time. China looks okay. Just think a few years ago, everyone was talking about ghost cities in China. What happened to the ghost cities? Well, they're just scary stories designed to fret you out. And they certainly did that. And even 60 Minutes in the US picked up on that story. What happened to those ghost cities? Go to them now, there's traffic jams. So a lot of rubbish comes out of China. Usually not from the Chinese, but from other Westerners who don't like its success. But I think at the end of the day, Chinese are doing a good job of managing their economy. The focus is now shifting to services sector, the old tertiary sector. If you go back to high school economics, there's now a bigger sector than the manufacturing sector in China. But growth in China, to me, looks okay. They don't want it to be 10% plus. They want 6.5%, something like that, something more sustainable. But at the end of the day, that's an okay environment for Australia. What about geopolitical tensions? I've gone through Eurozone. I don't see any issue with the German election this year. Merkel will win. Politics in the US, I've talked about that. Terror threat, big issue, horrible when it happens, but it's mainly a human consequence. The economic impact is pretty minor. And tensions with China, they'll wax and wane. Big one, of course, is Korea. I love Economist magazines. Brady Bunch and Economist magazines, they're the best. Covers, that is, the covers. I find it hard to get through their magazines because there's so much stuff in there. But they do have good covers. And these guys are a threat. Just worth putting this in context. Firstly, I think the most likely scenario in relation to North Korea, is a diplomatic one. The US, no. This is not Syria. This is not Iraq. You can't just go in with a surgical strike because missiles will be raining down in South Korea. Massive loss of life. And of course, on the other side, North Korea knows if they go too far, they'll be wiped out. Their regime will be wiped out. But of course, you do have a couple of things going on here. One is their capability has gone up dramatically, and two, you've got two somewhat volatile leaders on both sides, because that could lead to a policy mistake. So I think there will be a diplomatic solution. We're not there yet. This could go on for a while yet with ever-increasing escalations. If you look back historically, typical response in share markets around wars is an initial fall, hence that correction I was talking about earlier, and then an eventual bottoming out, usually before there's a resolution, then a substantial rally. And that could well be the way it plays out in relation to North Korea. Probably the best parallel is the Cuban Missile Crisis of October '62, if you want to Google that one. So moving on, interest of time, world still very low inflation, you know, the Amazon effect. Just bought a brand new Holden. I love Holdens. I decided I better get in there, otherwise they won't make them anymore and I'll never be able to buy a new one again. So I got in there, and it cost the same price as the one I bought in 2010, but it's got gadgets all over it. This is deflation or low inflation pressures in action. That still has a little bit further to go, although I think the worst is over on that front. But it means the rises in interest rates are going to remain gradual. One worth noting, though, is the US. I reckon the sentiment on the US is too negative. The Fed will kick in at some point, and so we're still hiking gradually, but that will mean that the gap between them and everybody else will start to narrow again, and the US dollar will go up at some point. What about Australia? Mixed story. All over the place. Yeah, we've been able to avoid a recession because of strength in the housing sector, because of strength in New South Wales and Victoria, which have filled the gap left by Western Australia, and also because of booming services exports. Look at education and tourism exports through the roof. Flip side, though, is that housing is starting to slow down. Housing approvals look to have peaked. Retail sales are still weak. A lot of constraints around consumer spending. So mixed bag on Australia. Okay growth, avoiding recession. The doomsters will be wrong, continue to be wrong, but we're not booming, and therefore we think there's still better opportunities elsewhere rather than Australia. So I won't go through the states. One big drag in Australia is, of course, the wages numbers, which are relatively subdued, and that's probably going to remain the case for some time to come yet. So, interest of time, one big thing that is a stuff up in Australia is the politics. Endless capability to get me depressed. Rudd, Gillard, Rudd, I thought that was all over, and then another guy comes along who's almost as crazy, or almost as out of control, it seems. And then Turnbull comes along, but he can't do anything. And now, of course, we have this debate as to whether foreigners are taking good Aussie politicians' jobs away from them. But that runs a risk that we may have an early election, and if that occurs, then it could adversely affect business confidence. So you put all that together, Aussie growth continuing, share market okay, but it does mean you've still got good opportunities overseas relative to Australia. And just on that, looking at valuations, I think they look okay. The US is the one you'd worry about the most. On our valuation measures, we look at a whole bunch of indicators. It's slightly expensive, whereas Australia, Europe and Japan, fair value slightly cheap. On Australia, good profit growth recently. Profits are up after a couple of years of declines. That's a good thing. Just bear in mind that profit growth was narrowly focused on the resources sector. Strip that out, underlying numbers aren't quite as strong. And the underlying profit growth in Australia running around 5 or 6% compares to, say, 10% in the US, 20, 30% in Europe and Japan. So that's why we think there are some better opportunities offshore rather than in Australia. But Australia is still okay. Search for yield, that continues. Bond yield's very low, so in recent times, you know, seen a lot of demand for residential property. I reckon we're getting to the point where Sydney and Melbourne property are starting to roll over. Look at the auction clearance rates, they've slowed down. I reckon if you were a sensible investor looking to buy low, sell high, you'd be looking at Perth at the moment, not Sydney or Melbourne. And you're also going to get a much better rental yield in Perth. That said, if you don't like commercial property at all, don't like residential property at all, and there's good reason not to, very low rental yields, good massive gains in some cities, you could look at commercial property where the yields are still relatively high, and that's, I mean, office, retail, industrial. So I'm about to wrap up. Just look at this. This is why I'm a little bit cautious on the Sydney property market. The crane count has gone through the roof. These are cranes building residential apartments across Sydney. Sydney has gone through the roof, and there's going to be a lot of indigestion out there when a lot of those apartments come on. So I'd be really cautious about Sydney property. What about the Aussie dollar? It surprised me. Unfortunately, over the last 18 months, it's gone up. I thought it would go down. I reckon, though, the Reserve Bank at some point will keep, well, the Federal Reserve in the US at some point will continue to tighten later this month and then later this year on interest rates, and that in turn will occur at a time when the Reserve Bank in Australia is on hold, and that will see the Aussie dollar resume its downswing. So you can see roughly there the gap between Aussie rates, the red line, and US rates in red, that gap. Usually when it's falling, the Aussie dollar goes down, and I think that will probably remain the case. So just summarising before I hand back to Steve, key point here is global growth is okay. Yes, we could have a correction, quite a sharp, a bit of a pullback in the short term, but I think the fundamentals for growth assets and shares still remain pretty positive. So on that note, I'll hand back to Steve. Thank you.
Thank you, Shane. Great update, and it wouldn't be an economic update without a reference to the Brady Bunch. So thank you. And just a reminder for everyone on the line to please submit your questions for Q&A. So over to Nader. Nader, welcome. Shane obviously highlighted a few things there in the last sort of 15 minutes or so, that there always seems to be a lot of noise in markets, or as I think Shane referred to it, a wall of worries. It is hard to find value in some markets. Bonds are looking pretty expensive, as are sort of some of the developed equity markets are looking pretty stretched in terms of valuations. I guess given this environment, how are you thinking about investing capital at the moment? It seems to me maybe having the flexibility to be able to shift between asset classes is pretty important. Maybe some thoughts on that?
Sure. Yeah, well, thank you everyone. Thanks HUB24 for the opportunity. And you know, Shane went through the macro outlook and the impact on asset classes. The world is very macro, and you could be buying the best stock in the worst sector from a macro point of view, and that doesn't make a difference. So being macro aware is very important, and we are fortunate to have access to Shane and the team's insights where we are in the economic cycle. But then more importantly, if I just go through some of the slides, you know, like fashion, markets go in and out of cycles all the time. So the aim of multi-asset investing and the ability to having the flexibility and scope to change your allocation depending on where you are in the cycle allows us to be fashionable but not end up becoming a fashion victim. Right? So when asset classes become crowded and expensive and fashionable, too fashionable, it's usually a time that, you know, that performance has run its course. You got to think about some other areas of the market. So you need to have the flexibility. For example, just remember in 2000, tech stocks were the fashion. Then in 2007 was housing-related stocks in the US. 2010 were resources stocks. And now we're back to some big tech stocks like Amazon and the rest. So these are the fashionable areas for us. It's just to stay away from that crowd and look for opportunities where they are underappreciated, which I will go through. The other one is that, you know, central banks play a major role on the relative performance of asset classes. So again, this is macro. Macro is very important. So the chart that we have there is the size of US Fed balance sheet, currently about $4.5 trillion. If you add ECB and BOJ's balance sheets, that adds up to around $14 trillion. So those central banks have made it quite clear that the next phase will be shrinking those balance sheets, right? And when you see in that chart is the relative performance of some of the tech sector, call it defensive growth sector, and the other side, the right-hand side, is the relative performance of financials. So you can see that the defensive growth sector has clearly benefited from this phase of QE in markets to the detriment of the financial sector. So financial sector, and the relative performance between the two is pretty extreme. So where to from here? As I said, it is an environment that we're moving from QE to QT. QT being quantitative tightening, and as that blue line starts coming down, it will have implications for asset class relative performance. And again, multi-asset is well placed to see those changes in dynamics and change allocation accordingly. So you have the flexibility to do so. The other one is the impact of what we've seen over the past few years in terms of quantitative easing on volatility. So we have again a chart of US Fed balance sheet, and the other one is VIX, implied volatility in the US. And volatility is being suppressed. We've had central banks put in place. So every time news became bad, remember the time that bad news was good news. So every time news became bad, markets would go up because it would increase the possibility of central banks doing more easing. That phase is likely over. Again, the central banks have made it quite clear that there won't be much, from next phase will be quantitative tightening, not more quantitative easing. So there will be upward pressure on volatility over time, and with it, correlations will change. There will be more potential corrections in markets, more setbacks. So the ability to separate noise from signal is very important here, and the ability to have hedges in the portfolio when there's a lot of noise and it's not priced in. So there are times that you want to have hedges in the portfolio to protect yourself against a drawdown. But when everyone's priced that in and noise is priced into the market, then that's the time you actually want to take the hedges off. So again, multi-asset allows you to have your core views, core allocations to sectors, the areas of the market that you want to have to be exposed to, but at the same time manage that volatility that is likely to be on the rise through tail hedging strategies.
So Nader, just obviously you mentioned it's critical to be thinking about multi-asset as an investment in its own right. I guess as a PM of a fund that's $1.9 billion investing across sectors and regions, what are you looking for? Is it purely just a valuation story? Are you looking at improving fundamentals, or do you want to try and avoid the crowded trades and be contrarian almost in your views? I guess what's sort of some of the key things that you think investors should be considering?
Right, so at the end of the day, we would like to have a return profile which is similar to equities with half the volatility and lower beta. How do we do that? First of all, we have a way to filter that noise. So you need to have a process to be objective. Very important. So when we talk about being objective, it's not it's not being quant, right? So we're not talking about artificial intelligence and letting computers or algos to run the process. That doesn't work because the world is a lot more complex than that. And if you remember, you talk about, you often say, fool me once, shame on you, fool me twice, shame on me. If you remember 2007, we had the quant quake. And that was the time that we relied on algorithms and quant models too much to the point that they blew up, and in some cases took the rest of the market, posed a systematic risk to the rest of the market. So algorithm is not the answer, but being objective is the answer. Being objective doesn't mean you're going to be quant. It doesn't mean you just have a black box. Being objective means you need to switch off your emotions. You're going to have to be objective, evidence-based investing. As Shane said, a lot of noise in the market, the ability to separate that noise from signal. So the way we do it, we don't look at the data and information that comes to us in just one whole, like a scattergun, because will get very confusing. We look at markets through 5 drivers. We'll call it 5 lenses: the valuation lens, earnings cycle lens, monetary policy lens, sentiment, and technicals. So the asset classes that we typically gravitate towards are asset classes that are cheap from a relative value point of view. They are unloved from a sentiment point of view, so there's a pessimism around that asset class. They're oversold from a technical point of view, and where the cycle backdrop is getting less bad. Right. So there is no way we can find an asset class that offers good upside based on if earnings are already so strong, because that's pricing. So from then on, it will be momentum, right? So to be able to manage those drawdowns is to avoid those crowded areas of the market, because they will just, when things go up on momentum alone, then when momentum ends, volatility kicks in, and then you suffer a big setback. So it allows us to be value at extremes, by growth at a reasonable price in the middle. So right now, we've been through this like a 10-year bull market in shares. So there's a lot of the value at a broad base level, market level, there's less value opportunities. But at the same time, as Shane had the valuation chart for many markets, some areas of the market are expensive, like US, but there's a lot of other markets which they're not cheap and they're not expensive. But growth numbers are improving, right? So that's growth at a reasonable price. If we wait for that growth numbers to come through 12 months ago, we would have missed all that upside. So because market signals usually come from valuations and things getting less bad, And then when things become actually good, when people realize, then you have growth at a reasonable price. And that's the phase we're in. There's still opportunities, but that will come with higher risk and potential correction, which Shane mentioned. So the ability to put hedges in the portfolio through options or other asset classes will be quite important. Then, there are some examples of areas we have high conviction positions in. Initially we talked about central banks' balance sheets and relative performance of financials. So financial sector has been negatively impacted by QE and also the negative interest rate policy. So the charts there shows bond yield in Japan and Europe and relative performance of banks in those markets. So if there are two markets that the banking sector has been impacted negatively the most are Europe and Japan, where interest rates were negative. So you just have all these banks having massive amount of excess reserve, putting it with the central bank earning negative interest. So that's basically squeezes the margins. It's bad for banks' profitability. And if that phase of negative interest rate and quantitative easing is ending, and central banks have clearly suggested that from here, the relative performance of banks should improve. And you saw the first two charts had relative performance of banks versus tech, really extreme. We're moving to a new regime, so here's an opportunity. So we have allocations to European and Japanese banks through ETFs, but we also need to manage the currency exposure that comes with that. For example, for Japanese banks, if you're buying Japanese banks ETFs on the Japanese exchange in JPY, we need to make a call around the currency Japanese yen versus Aussie. So in that case, we actually have hedged the position and brought it back to Australia because we believe Japanese yen will continue to weaken. So again, managing currency as a separate asset class in a global framework is very important. The other high conviction allocation that we have in the portfolio is global energy. The two charts there show relative performance of the energy sector versus oil prices. We've had oil prices bouncing up and down between 47 to 50 or so. I mean, we look at the relative performance of the energy sector relative to the rest of the market, there is a massive disconnect. So global energy stocks haven't even kept up with the rise in oil prices, number one. So there's a big dislocation there. Number two, why that's the case? Because no one believes that oil prices will likely to stay high. Why they don't is just the fact that oil inventories are very high. But underneath that, we talked about when you look at an opportunity, when fundamentals bad and becoming less bad, that's important, and that's what's happening in the oil price. Inventories are high, but actually coming down at a rapid pace. And also, when you look at the shale productivity in the US, which has led to this big rise in inventories over the past few years, shale productivity is clearly declining. And why that's the case? Because the easy gains have been seen in shale. A lot of new wells that they dig, it is interfering with the old ones. And so they need to dig a lot more wells to keep the productivity the same, because every time they dig one, they lose productivity on two. So they need new technology. And over the past 2 to 3 years, one area that has been in massive recession has been the energy sector. There hasn't really been much capex in the shale. So there is a lot of potential for capex, and oil prices will likely head higher because, first of all, there's a lot of pessimism around it. Market's not seeing things actually getting less bad, and there's a lot of attention is on shale production, but underneath that, shale productivity as well is actually declining at a rapid pace. And when we look at the valuations of the energy sector, it's very cheap. So cheap sector, fundamentals become less bad. From a sentiment point of view, very pessimistic.
Fantastic. Thanks, Nader, for those couple of trade ideas, if you like, in your high conviction ideas in your portfolio. Shane obviously talked about some of the geopolitical concerns that are going on in markets. It'd be hard to manage specifically for such events, but how do you try and hedge a portfolio or protect capital against not just geopolitical issues, but I think any other sort of tail risk events. Obviously, gold or US dollar or bonds are your traditional safe haven assets. How are you approaching that, and what are some of the ideas that you might be able to share with the advisors on the?
Sure. I mean, it's all a game of, this is not a business of certainties, it's all probabilities, right? So when we look at North Korea, for example, as Shane had a slide, the probability is medium to low of happening, but if it does happen, the impact is very high. And one asset class that does well in every geopolitical tensions of the past, or wars, has been gold. We have a 3% allocation to gold, which is not a big allocation, but it's a tail hedge. Because in the event of any war, and this one is potentially a nuclear war, which, hopefully that doesn't happen, but if things actually escalate from here, gold prices are likely to multiply several folds. So a 3% allocation to gold, which will be one and only pretty much asset class that would rally very hard, is a tail hedge. So probability low, impact very high. So small allocation to an asset class which have a big turn, a big rally in the case of that event. The other one is that when every period the market sentiment is complacent, like Shane mentioned, sometimes there is a lot of noise, but it just feels like the market is running a noise cancelling headphone, right? So it's not priced in. So there's a lot of uncertainty. But there's a disconnect between the uncertainty and what's priced in the market. Look at US equities, for example. They haven't corrected for one whole year. It's just been one steady rise, and every correction gets bought into. And it gets to a point market becomes complacent. And that's a phase that we would like to look at hedges in the portfolio, because when it's just markets do their best to surprise the majority. And the majority believe in one direction and thinking, well, corrections are shallow, bigger correction will come. So how do we get around that? We look for asset classes which will have a negative correlation with the rest of the portfolio, and on its own, they're a good trade as well. For example, right now, we've seen a massive 180 turnaround in sentiment towards the US dollar. At the start of the year, no one could see US dollar just going anywhere but up. The whole world, everyone was positive US dollar. Now US dollar is turned down, and I don't find anyone who's positive on US dollar. And so a lot of it is around pessimism around US. As Shane mentioned, US data is actually looking pretty good, and a lot of it is in politics. And if anything, you have a majority Republican to House and Senate, so they would want to get something through before the midterm election next year. So the potential. So the point is, market expectations for anything positive is just almost zero. So it doesn't take much to shake that sentiment. And US dollar, when we look at the positioning point of view, again, as I mentioned, we've gone from extreme optimism to extreme pessimism. Great hedge in the portfolio. If we do see, if market corrects, those US dollar against emerging, the carry trade, emerging market currencies is a great hedge in the portfolio. So we have long USD in the portfolio against short positions and those EMs. And by the way, those EM currencies are good hedge in case of war as well. So not only that will cover us against a potential correction, but also it's a good hedge going forward.
Right. Dan, thank you for that insightful feedback. Maybe just one or 2 minutes on trying to wrap it all together now in terms of the global backdrop. What does it mean for asset allocation, and what are some of the sectors that you like? You mentioned the US markets are pretty overvalued, so there's an underweight there. You mentioned commodities, but maybe just quick 1 or 2 minutes on your current thoughts on asset allocation.
I'll just start by just saying, I want to bring it back to some virtues. We talk about, in some of the principles of life, we talk about trust, loyalty, and monogamy as being principles of life. In asset allocation, in investing, those things actually work against us. So we can't be loyal to an asset class, because the minute it becomes crowded and everyone's loyal to it, it goes against us. So this asset allocation that you see here now is very different to what it was 4 years ago. 4 years ago, our allocations were more towards the yield chasing areas of defensive growth areas of the market. And now those areas are just totally crowded. We have moved a notch up in the economic cycle, as Shane had. So we get into a phase that growth is becoming more sustainable. So our allocations in equities is becoming more cyclical areas. So we have allocations, as I said, to energy, financials, material, industrial, and some transportation stocks that within our equities. If I zoom into this slide here, you can see the actual breakdown. Within our equity positions, first of all, US equities is a very small part of our basket now. US market is expensive, most expensive equity market in the world. From a sectoral point of view, our allocations are more towards the cyclical part. So you can see energy, materials, industrial, and again, 4 years ago, that was REITs and others, high yield credit and others where we wanted to chase yield. And the Australian equities exposure is quite low compared to the rest of the world. Again, that reflects, like Shane covered that, in Australia you just have a very polarized market. The mining is doing okay now, but that's very cyclical. So smaller allocation to Aussie equities, big cash exposure. We have currently 30% in cash, and the reason we have that is just because, again, there's a lot of uncertainty, and market pricing that uncertainty, we don't judge market price that in. If that happens, we use that cash to get back in. Commodities, again, high allocation. We are at a phase of the late cycle. Every asset class performs differently depending where you are in the economic cycle. The phase you are in now, that's a phase that global growth is synchronized, and real assets, commodities, metals, energy, would do well. So we have 10% allocation in commodities, and then you can see the allocation to FX short as well as a hedge in the portfolio.
Great. Thank you, Nader and Shane. A very informative session, and hopefully everyone online found that session informative. And if you're interested in learning more about the asset allocation strategies or would like any other information, please let us know, and we're happy to follow up. So thank you, everyone. I'll hand back to Andrew now to facilitate Q&A for the next sort of 15 minutes or so.
Sure. So just a reminder to everybody, if you're using the through the webinar toolbar on the right-hand side, you'll see the function for questions to allow you to submit any questions that you want us to ask to Shane or Nader. So please do that. While we're waiting for some of those to come through, I've got a question here for you. You mentioned, Shane, the crane count in your presentation, and coming indigestion in the Sydney property market. Do you think that could lead to property prices coming off and decreasing, or more of a flatlining?
I think the risks are all skewed to the downside, but I'm not in the crash camp. So if you were watching Four Corners 3 weeks ago, whenever it was, you would have said, shock, horror. I didn't know about any of that. Well, anyone who had a sense of history would know all about that, because we've been talking about a property crash in Australian property on and off since 2004. So it's not really a new story. But I do think we're at a point, Sydney property prices up 75% over the last 5 years. Massive amount of new supply coming on in the form of apartments. That's going to lead to indigestion. We're already seeing the auction clearance rates slow down. They were 80% earlier this year. Lately, they've been pushing down towards 60%. We're seeing less financing going to investors. We're seeing banks raising interest rates for certain types of borrowers. So I think all of that will give us a calmer market. My base case is that we'll slow down through the rest of this year, and sometime in the next year or two, prices will come off 5 to 10% across Sydney on average. But if you're thinking of buying an apartment and there's a crane nearby, I'd be very cautious, because apartments in that sort of those sorts of areas could see price falls of 15 to 20%. But I'm not in the crash camp. To get a crash, you really need much higher interest rates, the Reserve Bank to get it wrong, or much higher unemployment, or this building boom to go on for another couple of years. And I don't think we're going to see those things, but I do think you have to allow for some period of weakness, particularly in apartments.
Terrific. Thanks, Shane. Just wait while a few more questions come through. Nader, one for you. In the commodities allocation there, I saw soybean.
Mm-hmm. Yeah.
Maybe comment around that.
Exactly.
It's an interesting one.
So again, soybeans, when we look at production levels over the past few years, we've had increasing production 3 years in a row. And it's usually hard to see the production increase the 4th year. So we have an asset class that is tight from a, you talk about stock to use ratio level, tight market, complacent to the potential adverse impact to supply. And now we are getting towards a hurricane season. We've seen the impact in some of the refineries, and already there are signs that a lot of crops in wheat and soybeans and areas are being rained out. So inventories are tight. There's a potential for disruption in supply, and it's a great market, and has lagged behind other commodities for many years. So it's an asset class that offers more upside than downside at this level.
Very interesting, thank you. All right, it looks like that covers all the questions that we've got through today. So thank you again to everybody for dialing in. We might wrap it up there. If you do have questions or want to get in touch with the AMP capital team, we've just had another question come through. Sorry, bear with me. So the question is suggestions for how the fund can be employed, core satellite alternatives allocation. Nader, Shane, who'd like to answer that?
Probably.
Yeah, I mean, it really is a growth alternative, liquid alternative growth, liquid growth alternative within equity. So if you look at the performance since inception, it's had equity-like return with bond-like volatility with a beta of 0.3 to equity. So it is more on the alternative side. It's liquid, so liquid alternative, and it is more on the growth, so liquid growth alternative growth.
Terrific. Okay, we've got another question come through. So is there any opportunity of growth in the energy market, or is the medium to long-term outlook pessimistic?
Depends what you think of batteries. I think we're going through a revolution here, but it'll take time to fully impact. So if you think about electric cars, they're becoming more prominent. At the moment, they are relatively expensive. Tesla will introduce one soon, which will come at a lower price, but there's also big subsidies involved. So most of the evidence I've seen suggests that as things currently stack up, it does cost a lot more to buy, run, and in terms of depreciation, an electric car than a standard internal combustion engine, which tells us that the internal combustion engine is going to be with us for a while to come. We are getting to a point where the fuel efficiencies on internal combustion engines are quite substantial. But somewhere out there, there will be this change. And that's why I think we're in an intermediate sort of period. So for the time being, I think internal combustion engine still remains there. There's still going to be demand for petrol and so on. But somewhere out there, maybe on a 10 to 15 year horizon, you will start to see much greater use of electric vehicles as the cost and the reliability and storage capacity of batteries comes down, and there's more charging points across the country. But as Nader pointed out, with shale oil, huge revolution. It's put a bit of a cap on the price. But by the same tokens, there are limits to this. And we are still at a point where the internal combustion engine is still heavily relied on. So I kind of think, there is a long-term cap out there. Long-term oil demand will eventually go down. There is a debate about peak demand for oil, but we're probably not quite there yet.
Yeah, so around every structural change of cycles as well. Like remember, we were talking about peak oil in 2008, and now the sentiment's turned around and talking about end of oil. And so we still don't have airplanes that you can fly on batteries. There's a lot of, Shane mentioned, there's a lot of demand for oil, and oil is used in so many other products. It's not just cars. The other thing I should note is that Tesla is still a loss-making company. So they're not actually making much money. So it's still expensive, and the sentiment towards oil, around our structural downturn potentially, we're at the bottom of the cycle. So we don't expect oil prices at 150 anymore, but where it is now, there's upside.
Just to give you a simple one, there's a rough estimate in the US or Europe that an electric car will add, you have one electric car and you use it on average amounts. For driving, it'll add about 20% to 25% to your average electricity bill. So if you're using 100, whatever it is, I can never understand the units with electricity, add 25% roughly to that. Now, if everyone did that, do we have the capacity with electricity generation to supply that? No, we don't at the moment. So this is going to take a while to really take off. I think, we all put solar panels on the roof, all have batteries where we can store, all can use that to charge our car. Yeah, fair enough, we can start to do it. But Australia at the moment is suffering from severe problems in terms of electricity shortages. We're one hot day away from meltdowns potentially. So this is going to take a long time to phase in.
Terrific. All right, thanks again, guys. So in the absence of any further questions, we will wrap things up. Thank you again to everybody for dialing in. Thanks to Shane, Nader and Steve for coming along today. If you do want to get in touch with the AMP Capital team, obviously you can contact their BDMs or you can contact your HUB24 rep and we will happily put you in touch. Thanks again, everybody.